Newfound Gold has discovered 93 grams per ton of gold over 19 meters, starting at only 96 meters downhole. Some of the biggest names in the mining world have shown their approval of what Newfound Gold has discovered. They now own over 35% of our shares. With over $70 million in working capital, Newfound Gold is well positioned for what the future brings. To learn more, find us online at newfoundgold.ca.
Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today on the program is a new guest to the show, Kevin Smith. He's the founder and CIO of Crescat Capital, not to be confused with the actor from Clerks. He has 28 years of investing experience. How are you today, Kevin?
Good. Thank you for having me, Tom. Appreciate it.
Great to have you. I was thinking we could start off by talking a little bit about China's debt bubble. You were mentioning in some of my research for this interview that they have a $40 trillion in non-performing loans. So let's talk a little bit about the debt bubble that they have and use that as a starting point.
Okay. Well, at Crescat, we're a global macro-oriented hedge fund, and the China currency and credit bubble has been one of our big themes now for several years. One that we've been expecting, a big currency devaluation. We've seen a little bit of that since 2015, but nothing like what we're ultimately expecting. And China's created over $42 trillion of credit in its banking system, and it's led to an enormous housing bubble. We think it has a huge non-performing loan problem that is equal to maybe 20% at least of that $42 trillion plus of credit in their banking system that they've created. And this is a major imbalance, and we think one that still has a reckoning still to unfold.
So as we're seeing that massive debt bubble, explain to us a little bit about the housing bubble in particular that has formed as a part of that.
Well, when we look at housing bubbles around the world, the base case to go back to is the one that we had here in the U.S. and in Europe back in 2007. And that was one where in our hedge fund, we have been very successful about identifying that bubble and getting out in front of it by being short home builders and mortgage companies. And we were short Lehman Brothers and Bear Stearns even back then, and did extremely well with that. But when you look at the household debt to GDP of the housing bubble in the U.S. and in Europe back in those days, and you look at other things like home prices relative to rents and things like that, the housing bubbles in China and Hong Kong, even in Canada and Australia that are somewhat related to those, have a signature print that is very similar to that housing bubble in the U.S. So in China, it's not so much household debt as it is price to rents. But in Hong Kong, it is household debt to incomes, and similarly in Canada and Australia. And anyway, I can get into more of the parallels, but there's many of them that we see.
So as you're speaking about the housing bubbles in Canada and Australia, relate to us about why those things are related to the Chinese debt bubble.
Well, part of the issue with China is that it's a totalitarian, communist-controlled country that has a closed capital account. And so the money has been trapped inside the deposits of the banking system, even though we think those the non-performing loans that they have make those deposits highly suspect in terms of the quality and the viability of Chinese banks to ever make good on them. But what's been going on is that the elites in China for the past decade plus have been the only ones who've been allowed to get capital out of the country. And they've been getting it out through all kinds of different channels. And guess where it's been going? It's been going to Canada and to Australia and to the U.S. And it's been part of the housing bubbles that have been created in those countries.
And as you were mentioning Hong Kong, Kevin, obviously we've seen major instability there recently. So in your opinion, what are some of the possible consequences of China really starting to control one of the most important financial centers in the world?
Yeah, the situation in Hong Kong is one of the most extreme macro imbalances that we've ever seen in a banking system and in a currency. And now that it's coming under full communist control and Hong Kong is losing that one country, two systems structure that they had, it's really one country, one system now. And you have these enormous banking imbalances. So the Hong Kong currency, the Hong Kong dollar, has been pegged for almost 40 years. But if it were a free trading currency similar to the imbalances with the yuan, we think it's one that would face a lot of of downward pressure. And the main problem is just the amount of banking assets that they have in the system relative to GDP. And yes, both Hong Kong and China would appear to be a huge pile of foreign reserves. Everyone will point to China's $3 trillion of foreign reserves, or in Hong Kong, I don't know the exact level of it. But when you look at the size of the banking systems relative to the foreign reserves, it's actually very low. And when you consider that in order to keep these currencies managed, both the yuan and the Hong Kong dollar, which is fully pegged, the central banks and the foreign exchange authorities in these countries have essentially had to engage in swap transactions with large global bank counterparties in order to make the bid on their currencies. And practically what this means is that those reserves are the collateral that backs up those swap transactions. And so the reserves are also encumbered. And at some point, it's like a margin call situation that we foresee as to when the dam breaks on these managed currencies.
So as we're speaking about currencies and all these different risks around the world, you guys have a 16-factor macro model. And I was wondering if you could tell us a little bit about what goes into that macro model, what it's telling you. And let's start by looking at some of the highest profit to earning ratios that we've seen as of late.
Yeah, at Crescat in general, we have about 8 different valuation factors that we look at to value the U.S. stock market. And so valuation factors are about 4 or 5 of the 16 different factors that go into that macro model you referred to are these valuation factors. So all 4 of them are near 100th percentile for what we call historical rank. So a historical multiple or valuation indicator that we use. All 8 of them are close to the 100th percentile for the most overvalued U.S. stock market that we've ever had. And on the PE ratio, we like to look at what we call margin adjusted PEs, and that kind of ties also to the Shiller-Cape ratio, the cyclically adjusted PEs. And it's just a way of smoothing out historical earnings to come up with, and cyclical companies to come up with a true sense of the valuation. And the PE was like the only one of the 8 different factors that wasn't fully in the 100th percentile. And now today, with the stock market up so high, near record highs once again, NASDAQ in new record high territory, the S&P retesting its all-time highs at the same time as earnings have been falling apart. We also have PE ratios now at near record valuations. We think valuations are higher than both the tech bubble in 2000 and 1929, but PE is just one of 8 different things we look at.
So as you're saying, basically all of this risk is inherent in the system right now. Why don't you tell us a little bit about the Crescat Global Macro Fund and how you're managing risk within that?
Okay. In the Global Macro Fund, that is our Crescat's flagship fund and strategy, where we're able to have multiple different macroeconomic themes that we express. And so when we can combine different themes, long and short, using currencies, commodities, equities, we're able to manage risk and have a hedged portfolio. Now, each individual theme, whether it's our global fiat debasement theme, which is our long precious metals theme, our short China currency themes, where we have the Hong Kong dollar and yuan short exposure, or our U.S. equity business cycle downturn theme, where we believe there's still another major leg of the bear market that's soon to be reignited, and we're net short in a significant way of U.S. equities. So we combine all the different themes. Those are our top 3 themes today that we just talked about in the Global Macro Fund. And that fund is where you get all of our themes, and we have about a dozen of them. But those are the top 3 and the major ones today.
Kevin, when you're talking about the Precious Metals Fund, explain to us a bit more about the team and the strategy behind that.
So we have launched a new precious metals fund at Crescat, and it's really a carve out of our global fiat debasement theme that's been a key theme within both our Global Macro Fund and our Long Short Fund. But today we've put together a team of people. Tavi and myself are the portfolio managers of that fund, as we are of the other 2 funds, Global Macro and Long Short. But we've added a third key person to the team, and his name's Quinton Hennigh. He's our lead geologic and technical advisor. Quinton has 35 years of experience in the mining industry. He's got a PhD in geology and geochemistry from the Colorado School of Mines. He started his career with Homestake, which is now Barrick, and then he worked for Newcrest and then Newmont. So he's been at three of the majors in his early career before spinning off into the exploration world as chief exploration officer and then president and CEO of a number of other companies. Today, he's chairman of Novo Resources, which is one of Crescat's largest holdings. That's a major explorer in Western Australia, and about to go into production there, in fact, that they just announced. We're really excited about that. And in any case, Quinton is advising us on an activist strategy in the precious metals industry where we are investing in a portfolio of 40 to 50 different mining companies today that we think have the potential to be some of the best and biggest new deposits in the world, not the old picked over dead carcasses of the last mining cycle, but the real new high-grade, highly economic gold and silver deposits that on a gold equivalent basis have the potential to be 5, 10, 20 million ounce deposits and mines that ultimately get into production. But the value and the opportunity today that we see in this industry, especially after a 10-year bear market for junior mining stocks, is in the exploration side of the industry. And that is some of these junior mining companies have been starved for capital now for, since 2011. And some of them have literally been left for dead, but are sitting on some choice assets in key jurisdictions all over the world. And Quinton he's a world-renowned exploration geologist, and he knows where these assets lie. He's helping us to find them and to acquire activist stakes in these companies, and that's what our new fund is focused on.
So is it because there's such a great potential in the exploration space for such an upside? Is that why you're going after particularly explorers?
Exactly. When we think about the opportunity for precious metals, it's a macro theme for us, and we're a macro shop. So we start with gold and the value of gold. And today, for us, gold has a price target of $3,000. It's a moving target, and that's based on the amount of money printing in the top central banks globally. It's a pretty simple model, actually, but it's had a remarkable track record long term. And in the short run, gold got too cheap as all the money printing was happening. People thought that the money printing was going to translate into inflation. Instead, it inflated asset bubbles in stocks and corporate credit. But now we have a situation where the money is likely to flow out of these overvalued bubbles that central banks have created and into the gold space. And anyway, so we start with the price of gold, and then we look at silver, which is incredibly cheap relative to gold. And then we go even deeper and look at the mining companies. The mining companies, they haven't been investing in CapEx and exploration, now for 6 or 7 years. It's been declining. Investors were mad at the CEOs of the mining companies for splurging and spending too much money. And so they've been starved for capital. And the big companies have said, let's let the explorers do the exploration. But the explorers have been even more starved for capital. And so the junior mining companies, and especially the exploration-focused companies, have been through one of the most brutal 10-year bear markets that they've ever seen. And some of these companies have been nurturing these wonderful deposits, but they've had no money to do any drilling to expand them. And so that's where we see the big opportunity now. It's not just buying gold, it's buying gold in the ground and silver in the ground. So silver is so cheap. Silver was $50 an ounce at its peak in 1980. That was 40 years ago. Silver got back up to 50 again in 2011. But we've seen some of the lowest silver to gold ratios, or the highest gold to silver ratios ever here recently. And so a lot of these junior mining companies are focused on silver deposits too. When you think about the leverage of turning gold ultimately into cash flow and buying gold in the ground, you could buy gold, you could buy silver, but if you want to buy gold and silver cheap, we like buying it in the ground today in these undervalued junior mining companies that have the potential to really build some big, highly economic mines down the road once the price of gold and silver really gets moving up. And when you talk about the price of gold and silver, the opportunity for it to be moving up, we think this is like the early 70s, and people think gold's already moved, silver's already moved. Well, go look at the rate of change when silver and gold started breaking out in 1972, 73, 74. I don't think we've seen anything yet. I mean, it's a hop, skip, and a jump here from the low 20s for silver to get back to 50 and then break out from there. And yeah, the mining sector has really heated up, and we've seen a lot of appreciation. It's been the leading industry group in the market since the March lows. But we think it's only the beginning of a new bull market.
When you were talking about the $3,000 price moving target for gold, do you guys have one for silver right now, Kevin?
Well, silver is just so incredibly cheap. And I think you want to look at things like the ratio of gold and silver in the ground. And I don't know exactly what that is on a parts per million or whatever, but it's something like 15 to 1. We were at like 80 or 100 to 1 gold to silver ratio not too long ago. And so, ultimately, look at the target price for gold. You look at something like more mean long-term ratio of gold to silver of 15 to 1, and that's how you arrive at your target price for silver, which is way north of 50 today.
Excellent. As we're talking about trying to identify these explorers that have this great potential, can you share with us some of the key factors? You mentioned jurisdiction earlier. Let's talk about some of the key factors that go into identifying these particular explorers that you're excited about and investing in, and maybe give us a couple examples.
Sure. This is where you really need to go outside the macro realm, which is more our expertise, and even the realm of doing discounted free cash flow analysis on companies, which is also a realm of expertise. And you really need to hire the geologic experts who understand what's going on. And that's why we're working with Quinton Hennigh. And he has 35 years of experience exploring for silver and helping to make some big discoveries. Quinton was instrumental, for instance, in helping to validate the discovery at Fosterville in Australia as an advisor to Eric Sprott. And ultimately, he advised Eric Sprott to increase his stake in Newmarket at the time, back in 2015, 2016, once they hit a new strike on a deep drill hole at this old mine in Australia that had been producing for years and years. And they found a whole new zone that ended up being turning into one of the most profitable gold mines of the last 5 years. And in a bear market, ultimately, Quinton advised Eric Sprott's company at the time, Kirkland Lake, to buy Newmarket, which they did. And this turned into one of the most successful investments ever in the mining industry for a company, but particularly during this last 5 years. And it probably made over $1 billion for Eric Sprott personally. And this is Quinton's expertise. And he knows how to find gold, and he knows what to look for. I don't know what to look for, but I'm learning, and I'm learning from Quinton. And we've got 40 to 50 in our new fund of these opportunities that Quinton is aware of. And 10 of them we think have the potential to be the next Fosterville. I mean, seriously.
Excellent. So maybe can you give us a couple key jurisdictions and examples of some of those 10 that you're very excited about, Kevin?
Well, one of them I think you guys are familiar with, and it's a company called Newfound Gold. That's a private company today, but it's going to be going public here very soon. And the drill results of that company to play on words, Newfound Gold, is in Newfoundland, Canada. And looking at some of the drill core on some of the big strikes that have been made in that deposit, Quinton sees parallels to Fosterville. And in fact, he bought a stake in the company in Newfound as a private company for Novo, the other company that Quinton is involved with, where he's chairman, and they have a major discovery in Western Australia right there alone. I think I already talked about that a little bit, but that's going to be going into production this year, their deposit in Australia. So Newfound Gold would be one, and Novo owns a piece of that. They're going public here soon. But I'll mention 5 other names and jurisdictions. One, SK Mining, which is in the Golden Triangle in British Columbia. We're involved in a company in Bolivia that's a multi-metallic mine with a ton of silver that is called El Oro, ELORO. We're involved in one called Condor Resources that has multiple deposits in Peru. They have 4 different projects. Any one of them is a world-class project. White Rock Minerals is an Australian company, but their new discovery is in Alaska. And it's something that has the potential to be a 10 million plus ounce gold deposit. So those are just a few names. If you want to look more and hear Quinton talk about some of these companies, I would suggest just going to YouTube and entering Crescat and Activist. And we've done 3 videos already with Quinton where we've talked about 4 of these companies. It's called Crescat Gets Activist 1, 2, and 3. And you can hear about all of those.
Excellent, Kevin. What other niche markets is Crescat focused on right now other than the precious metal space?
Well, some of the other big themes, of course, we've talked about with China and Hong Kong and our short positions in what are still the most overvalued stocks that we've ever seen in the U.S. market. And it's not just the growth stocks, it's cyclical stocks, it's the whole market. And we've got a portfolio of probably 90 different individual names that we're short in both our global macro and long short funds. So for us, we're focused on managing money across our strategies. And it's the global macro fund, the long short fund, and the new precious metals fund. We also have a precious metals separately managed account that we launched about 14 months ago. And that's, so while our private precious metals fund is for accredited investors only, important to understand that this SMA, the separately managed account that we manage at Interactive Brokers, that's for anybody. And we take accounts as small as $25,000 there. So, and you can look at our track record there. I mean, that fund is outperforming the Philadelphia Gold Mining Index over the last year, which is one of the best performing industries. And our focus on the junior space is really helping us to outperform even the XAU.
Excellent, Kevin. We can find more information about Crescat at crescatcat.net and also your Crescat Kevin on Twitter. Anything else you'd like to add as we wrap up, Kevin?
Well, I think we've pretty well touched on it for now, and I really appreciate you having me on, Tom. And anybody, like you said, crescat.net is our website, and we are very active on Twitter. Tavi and myself at Tavi Costa and at Crescat Kevin. Tavi's even more active than I am on Twitter. He's got some fantastic macro charts for anybody who wants to look at those. And I'm going to try to be getting more active here myself. I've been so focused on this new fund launch and these activist deals that we've been doing that you'll be hearing more from me as I come up for air now to get more active there. So stay tuned.
Excellent, Kevin. Well, we really appreciate it. And you guys have some of the best original charts that are on the Twitterverse and explain things very well. Thanks for your time today, Kevin.
All right. Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?